Welcome back, everyone. So far in 2019's preferred shares are having a rough time and are down 72 basis points, which is in sharp contrast to returns of the stocks and bonds markets. The main reasons that explain this underperformance are, first, a lower yield curve, as investors are increasingly worried about interest rates cuts in Canada. And this is important because lower yields will impact 80% of the market through future reduced coupons. Second, a general lack of interest in the asset class, because ETF flows have been negative 68 million year to date, which pales in comparison to last year's positive $1.25 billion. On the credit front, no significant event occurred, and the creditworthiness of issuers remains extremely solid, even though valuations are at a multi-year low. At the beginning of 2018, we made an assessment that the trade for capital appreciation had generally ran its course and that the risk-reward profile of the market was such that it was time to start thinking about capital preservation. We swiftly increased our exposure to fixed perpetuals and resets with a floor feature or very high back-end spread. This turned out to be the right call, but way sooner than we expected. Today, we remain overweight fixed perpetuals and have selectively reduced our holdings of defensive resets in favor of more discounted resets. We do not plan to reduce our allocation to fixed perpetuals at this time because they act as an offset to resets should rates start to move lower. For the next 6 to 12 months, we evaluate the 5 key drivers of the market that are sending us mixed signals. Interest rates. If the current level of the 5-year Government of Canada rate stays flat or slightly lower, then we'll be supported for future cash flows and thus the market. If, however, it was to go well below 1%, then we could see further downside in preferred shares prices. Volatility. We expect that volatility in rates will stay high because of the current macroeconomic uncertainties. Preferred shares volatility should stay high as well, given the prominence of ETFs and the impact of their flows on the market. Demand. The outlook for demand is muted but not overly negative, and we do not foresee any imminent catalyst to increase demand in a significant way. Supply. We're very bullish on new supply being low for the foreseeable future. Preferred shares are expensive to issue for traditional issuers, and even the banks are starting to issue alternative securities in the US in order to generate the volume of capital that they need. And spreads. They're very wide right now, approaching crisis level highs. We believe that they are too wide when compared to corporate bonds and that a dislocation exists between credit fundamentals and preferred share spreads. For that reason, we feel that a significant buffer exists in valuations and that investors will benefit from it through the passage of time. So when we blend all of this together, we feel cautiously optimistic about the preferred shares market as fundamentals are generally sound. Looking beyond the potential dip that we could experience during this year's tax loss selling season, we expect that 2020 will be a better year than 2019. No matter the circumstances, we will not deviate from our strategy that revolves around quality, balance, and relative valuation that served us so well in the past and will continue to do so. Thanks for watching, and I'll see you next time.